Welcome to Markets Now. I'm Michelle Rook along with Shawn Hackett with Hackett Financial Advisors. Well, we had a mixed close in wheat on Monday, but higher in the row crops and cattle futures. Hogs were lower and so was cotton. So let's kind of slice and dice this, Shawn. First of all, row crop sector to the plus side. Was that weather premium or report positioning? What do you think?
Report positioning, in our view, 100% report positioning. I really feel that they hit the market so hard late last week that the market is just a little gun shy, that maybe the USDA might throw in a surprise and catch the shorts off guard. And so I think that's what we saw today is a healthy round of profit taking on short covering.
You bet. So let's talk about soybeans, though, because we have to get this 4 million acre cut worked into the ending stocks figure. And so where do you think we're going to come in at? We're around a 200 million bushel ending stocks figure, which is down about 150 from last month. Is that reasonable?
I think it's reasonable. I think that would make sense. Obviously that would mean them, not really changing the demand side picture too much, but I think that's a good benchmark for them to go by. And then from that point, we have to look at the month of August, as you know, Michelle, the key month for determining yields. Our advanced weather work says a warmer, drier pattern may develop, creating the conditions for a possible major crop problem. The one that we thought we were going to have in corn may actually be what happens in soybeans. And that's really something to watch with these lower acres of a possible explosive August. We haven't had an explosive August for soybeans in a very, very long time, but certainly that's on the table this year.
Yeah, so we don't have a lot of wiggle room here, obviously. We don't have any room for error. And so if that is the condition, this market is going to go up. But how high does it have to go? I was surprised we didn't get above $14 when we had the 4 million acre cut. So is that enough to push us up there?
Well, I think the market correctly stayed under 14 because if August is good and we have trend line yields or maybe above trend line yields, we can make the balance sheet work. So I kind of feel the way we get over 14 or even substantially above 14, you really have to have hot, dry weather moving into the pod filling stage in August. And if that develops, or even the worry that could develop, then the market's going to take out 14 and then all the technical indicators really start to take off there. Remember, though, what's going to stop it? Importing beans from Brazil would stop it. If you remember 2012, the second we imported corn from Brazil during 2012, that was the top on the corn market. So that would be a big marker to watch once we start, if and when we start importing soybeans from Brazil, if it gets to that stage.
So the situation is much different for corn, obviously, but if soybeans do take off, does corn have to follow?
Well, it has to follow unless we want to plant the entire country of Brazil to soybeans, right? I mean, we already know that they keep adding acres every year to soybeans the way it already is. And if we really get the soy market going and we don't create an adequate economic competitive price for corn, we're going to overdo it. And we're going to find ourselves in the first quarter and the second quarter of 24 having a glut of soybeans coming out of Brazil. So I think the market always has to balance current fundamentals with what the future fundamentals could look like. So I think that 3-to-1 ratio, Michelle, needs to be maintained, even though current fundamentals for corn may not justify 6, the future fundamentals would.
Yeah, so let's talk about the current fundamentals, because anyway you slice and dice this thing on Wednesday, you're looking at a pretty bearish ending stocks number above 2 billion bushels. But will USDA make any adjustments to yield this early?
My inclination is they will not lower the yields because of the good looking weather we've had here in July. I know a lot of people say they don't look at that and they look at other things, but I kind of feel, given their inherent nature not to mess around with the July yield, I just don't think that the way the crop is developing right now, that they're going to be in a hurry to lower yields. They typically like to wait for August to start making those adjustments. My speculation is they're not likely to mess around with the yield number, and they're going to just keep it square and, of course, add those acres and create potentially a larger ending stocks numbers as a result.
Oh, yeah, and that could get really bearish if they do that, obviously. Okay, so what about the wheat market? Spring wheat is kind of trading on its own with some weather concerns there. We're putting weather premium in that market.
Absolutely. I mean, we're just starting, really. I mean, I think we have a long way to go to get whether sufficiently premiumed up in that market. If you watch the spring wheat, KC wheat spread, it's really starting to move up over the last weeks. Spring wheat could trade $1 to $2 premium to KC wheat if you really get a major crop problem in the U.S. Remember, Russia already has irreversible damage to hot, dry weather. Um, Estimates are 10 to 15% below trend, and they produce as much spring wheat as North America does. And the forecast for the next 3 weeks in the northern plains and especially in the Canadian prairies, a very critical time for defining yield, looks really, really hot and dry. I think spring wheat is one of the markets to watch. It could really, really have something necessary to do here based upon the weather at this point.
Okay, so spring wheat higher today, the other two classes lower just because of that spread trade.
Absolutely. 100% agree with that.
Cattle market, let's go over there. Back up here today. I always say that market is very resilient. It's like trying to keep a beach ball underwater. And is it going to stay that way?
My suspicion is, and the suspicion of others, is that as we end the high demand part of the grilling season, and we know that the dairy industry in the United States is experiencing some of the worst margins in history, and we are starting to see the cow cull rates really, really take off, and that's going to lead to some significant increases in supply and at least the lower end of the market. I think, Michelle, that's enough to create some long liquidation from speculators that have been willing to hang in there, week after week and month after month. I know I've said this before, and obviously, as you said, the beach ball has proven me wrong. I still think that's a strong potential here going into late summer. And I sure think that I would be making sure that I would protect my downside if I'm a cattle producer right now.
Yeah. And of course, the cattle producers are very bullish because of these tight supplies. But at these levels, your point is well taken about trying to do some hedging up at these very high levels. Okay, a couple other markets I want to talk about. Cotton down pretty hard here today in the D's contract below the 80 mark. But you and I have talked about this coiling action on the charts. And at some point, we're going to break out of that, right?
That's my anticipation, and we've done nothing to break down or break above it. We're still coiling. I think today's decline is a little bit of a worry over the USDA report. The export numbers that the USDA has been using, it does not look like we're going to make, Michelle. So that creates worry that we might see some increases in ending stocks on Wednesday due to a lowering of U.S. export expectations from the USDA. Having said that, once we get that out of the way, though, I still believe weather is still very important to cotton yield determination. And hot, dry weather in Texas looks like it's going to continue to play out into the end of the month. And I think ultimately that will win out and provide that breakout to the upside of this coiling pattern. It's been around for months now. That's still going to be our expectation. Today was a little, once again, position squaring over the USDA report on Wednesday.
Gotcha. And let's finalize this discussion talking a little bit about natural gas, just from the perspective that, we've rallied off the lows. But you think there's more upside and that producers need to be a bit defensive here then?
Yeah, I mean, the way we're seeing it right now, if you look at Europe, extremely, extremely hot weather has been there for several weeks. It's going to continue. In fact, it looks like it could reach record hot levels. When we look at the United States, it looks like we're going to see some significant warmer temperatures, not only for the West and the South, but the Northeast looks like they're going to start getting into the picture. Much, much stronger demand for electricity, for cooling demand than we've seen in quite some time. While that's going on, we've also seen production starting to kind of slow down, level off. And this says to me that we might be ready for some kind of a weather-related, heat-related weather rally going into the end of the summer to kind of, finally, put an upside into a market that has been one of the most brutal bear markets we've seen in a long time.
That is for sure. All right. Thanks for joining us, Shawn Hackett with Hackett Financial Advisors. And that's Markets Now.